Is the U.S. economy going to be stronger than before the pandemic? Well, usually U.S. recessions leave lasting scars on the U.S. economy, with unemployment levels rising and remaining at elevated levels and taking many years to recover. However, this time appears to be different. Let's find out why now from Zacks chief equity strategist and economist, John Blink. John, you wrote that this year appears to be different. Why do you say this time is that way?
Well, Terry, I'm going to start off in a way that means people will now acknowledge that I actually do have a PhD, and I'm going to talk about the intellectual history of macroeconomics itself. Truly, the subject didn't exist until John Maynard Keynes wrote Money, Interest, and Employment in the 1930s. And then they formalized his logic. So why does this matter today? Because a pandemic hasn't happened since 1918. So John Maynard Keynes never addressed or even thought about addressing a pandemic suppression and how to get out of it. It was a totally different animal. It was a stock market collapse, a real estate collapse, a total unemployment rate of 25% that he was addressing. So from that came a set of models and a whole propagation of a way of thinking across all the doctoral programs, leading doctoral programs in the United States about what's called Keynesianism, which is spending drives growth, which lowers the unemployment rate, and the government should be activist. And that has dominated the thinking. Trillions of dollars have flown out under the Keynesian idea, with the big problem being Keynes was not addressing a COVID or some other type of viral suppression. These are not new to the world, but they are new to the subject of macroeconomics. And frankly, nobody is understanding that this was different. Just for example, the downturn they now marked for the COVID suppression was the shortest on record. It was only 2 months long before the economy turned up back last summer. That's never been seen. So why should we ever think like we've been thinking when already the whole downturn upturn story is completely unique?
So could it be that the pandemic was the catalyst and accelerator for developments that were already underway before the recession?
There's no question that's the case. You see it in the growth rates being driven by productivity gains at the macroeconomic level. And what that means is people jumped into ways to run remote services, and a lot of those did improve. They got rid of meetings, they got rid of travel expenses, they got rid of a lot of unneeded commuting. So this probably did generate a totally different framework for the U.S. economy going forward.
Also, despite many businesses having to close because of the pandemic, the U.S. economy has, so far at least, shown a resiliency and ability to adapt fairly quickly to the unforeseen impact of a complete shutdown of social activity. So what accounts for that?
Terry, it's like the medal count in the Olympics. I mean, at the end of the day, why do we always lead it? The answer is because we got 330 million people. If you adjust for population, for example, the Australian economy is 26 million, but a tenth the size of us. Just their medal count for their population, they're far greater athletes than us, but we're always going to win because we're big. And this is the basic point of the United States: is amongst leading advanced economies that are European-based or North European-based or Western Hemisphere-based, we're just the biggest. And that makes scale bigger, scope bigger, companies bigger, and that is a lot of why we just work so well.
Do you see then an impact to the economic growth here from the Delta variant?
I'm actually kind of neutral on the Delta variant because, yes, it's causing some masking to come back, but it's also causing a lot of people to get more vaccinations. And we're moving from a 50% overall vaccination rate up into stronger increases daily and weekly than we've seen in a few months. So Delta variant, from a fear factor perspective, is actually bullish.
The Fed just concluded a 2-day policy meeting. When do you think the curtailing of its bond buying program, thus marking the first step to an interest rate hike, is going to become apparent?
Well, let's imagine, Terry, that Jerome Powell, who's up for his second term on the February 2022, knows this. I don't think that's a controversial statement. And if you're at the end of 6 months, 8 months away from the end of your term, the likelihood of you doing something controversial like a taper is pretty low. So certainly he can do that, and he would have to be pushed by the FOMC to do that. which would then lead the FOMC and him to be at loggerheads, and they don't like that. So in general, I would understand the taper to be a post-February 22 event.
We've seen the most recent GDP number come out and data on personal consumption expenditures inflation's index. I believe as we speak here, those numbers are public. How significant are those numbers to the economy?
Not really that significant because it's all priced in from the earnings reports and the ISM manufacturing comments and other things that are monthly. Problem you have with the GDP accounts are quarterly and they're basically delayed because it's a big, big number and the government has a lot of data to get through. So by the time the government tells you what you know or what they know, you already know it yourself.
What about raising the debt ceiling, that talk that's resurfacing now? Is that just another way to buy into economic prosperity?
Well, Terry, this gets into some very poor decision-making about breaking off debt ceiling decisions from budget decisions. There used to be a time in this country where we had the debt ceiling rise immediately with any budget. That's obviously the solution. There was a tactic that was thought to work, which didn't, which was maybe you could use the debt ceiling as some kind of cudgel to lower spending. Obviously, that has failed dramatically with debt to GDP ratios over 100% in the midst of all this change. And it only creates contention. So that whole idea is just a wash of stupidity at this point.
U.S. consumer still seems alive and well here. So let's look at three of the biggest retail names: Walmart, Nike, and Target.
Yeah, let's talk Walmart first. Incredibly nice chart. Last earnings surprise, 38%. Average of the last four price, 18%. This company is doing extremely well. They got a really strong model for this environment. And the stock's not overpriced. It's a value score of B. I see a Zacks rank on number 2, a growth score of A. Very hard not to like Walmart in this situation. It's a great company and continues to perform. Nike, another Zacks rank number 1. But the issue with Nike as a stock is not the company, the stock. The value score here is F. And the PE ratio on a forward basis is 39. So when you're buying Nike at 165, I think it's very, very fair to say everything's priced in and then some. And the momentum traders got in on the last earnings report and drove the stock up. I would stay away from Nike. Target, unbelievable performance on a stock like this. It's now at $257 a share. It went on July the 29th. But interestingly enough, the value score is B and the growth score is A. The momentum score is A. And the Zacks rank is number 2. So bottom line with Target is it's probably going to keep going up. And that's, again, much like Walmart and Target, those are the names I would probably stick with. The Nike thing, I would be a seller, not a buyer.
Chief equity strategist and economist John Blank on the strength of the U.S. economy. With John, I'm Terry Ruffalo.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.